Welcome to Business Shark. Our topic today is Netflix's massive free cash flow explosion. I mean, look at this chart. Until 2019, Netflix was a cash burning machine, and many analysts believed that it would never turn cash flow positive because of the huge cost of content production. But then something magical happened in 2020. Netflix finally turned free cash flow positive. However, critics quickly dismissed it as a one-off caused by the great pandemic and the subscriber surge that was connected to it. Nevertheless, in 2022, the pandemic was already behind us. Netflix did it again. Another year of positive free cash flow, and the biggest surprise came in 2023 when Netflix free cash flow surged 4 times the previous level, and it stayed that high in the following year. I mean, this is really incredible. Is this the new normal? Let's dive into it and find out what's behind Netflix's massive free cash flow explosion. But before we can start our analysis, let's just take a quick look into the definition of free cash flow. It starts with net income or profit from the income statement, and then we add back depreciations and amortizations because these are non-cash expenses that reduce net income but don't use actual cash. And then we add back or subtract changes in working capital, and working capital is just the cash that is tied up in our current assets or liabilities. So we get operating cash flow, and the operating cash flow is the cash flow our company is able to generate through its core business activities. From that we subtract capital expenditures, and capital expenditures is cash spent on long-term assets like equipment, property or technology. And finally we get our free cash flow, and it's called free cash flow because it's the cash flow that can be used to pay for dividends, reduce debt or buy back shares or invest in growth. And that's why investors really love the free cash flow. So the starting point and the first input of the free cash flow calculation is net income. And as we remember, net income really exploded in 2024. We can see it here, it rose sharply from the 2023 level. And that actually explains the rise in free cash flow, because a higher net income has a positive effect on free cash flow. But what happened in 2023? We can see it here. Growth was really modest in that year, but free cash flow was already really high, and that's a real mystery. And to uncover it, we will have to dig even deeper to find the reason behind the rise of free cash flow in 2023. Now let's take the next step. Remember, the formula for free cash flow is operating cash flow minus capital expenditures, and Netflix content investments are capital expenditures. And we see that in 2023 Netflix content investments went down, and that partly explains the rise in free cash flow in that year. But you may ask, why are capital expenditures not included into net income? And that has something to do with the matching principle of accounting. Instead of expensing the whole cost of content right away, the company spreads it over the useful life of content through amortization. And amortization is a very important term, so let's look into it. We start with the year 0 here. Netflix produces some content, and the content costs are $100 million. So we have a cash outflow of $100 million on the cash flow statement. But we have nothing on the income statement yet. So you see it here, it's still 0. But then in the year 1, Netflix starts to stream the content and the content generates revenue of $50 million. And only then Netflix starts to recognize the cost of the content with $20 million. So net income is $30 million. But as amortization, you see it here, is a non-cash expense, we have to add it back to get the real cash flow of $50 million. And amortization helps Netflix to match its content costs to its content revenue. So instead of expensing everything in the year zero, Netflix spreads the cost over the period of time the content is generating revenue. And that improves income reporting and shows how the content is consumed over time. Now, let's take a look at Netflix content amortization expenses, and we see here that they are rising year by year steadily. And this has a simple reason. Netflix has spent a lot on content in the previous years, and now that content is amortizing. But we already know that amortization is a non-cash expense. It does affect net income, but it does not affect free cash flow. Now, let's put everything together and visualize it. We have here in green Netflix free cash flow, and the blue bar is net income minus content investment plus amortization of content. And we have already learned that amortization is a non-cash expense, and that's why we have to add it back. And we see here in this year's actually that these three factors are a pretty good explanation for the rise and fall of Netflix free cash flow. So Business Shark community, what have we learned today? Netflix free cash flow has risen sharply in 2023 and 2024, but there were two different reasons for the rise. In 2023 it was lower content investments, and in 2024 it was a revenue explosion. I hope you enjoyed the video, and never forget, Business Shark community, attack and bite.